Since July, we've seen an unexpected international crude oil price slump in the petrochemical market. We would expect industries such as coal, chemical, new energy, and even into the global economy to feel this influence. Today we have invited Derek, an energy and chemical analyst with ECI, to talk with us about the situation. Hello Derek, it's nice to see you again.
Hi.
But first, let's talk about the influence of the petrochemical industry and how the price slump has affected it. What are your thoughts on this issue?
I do have some thoughts, but also some interesting data to share. As you mentioned, petrochemical product prices have been moving down steadily since July. To get an idea of the magnitude of the move, according to SCI, West Texas Intermediate prices have dropped 29.47% and Brent by 30.11% between July 3rd and November 27th, when it closed at the lowest point in 4 years. It's not surprising that the prices of other energy-related products have been affected.
Since it's been affected so heavily, do you have any examples for us?
Let's look at some examples from China. Imported LPG fell by 21.26% from 6,350 yuan per metric ton to 5,000 yuan per metric ton. Chinese refined oil, which happens to be regulated by the National Development and Reform Commission, dropped 9 times in a row. 93-octane gas fell by 11.37% from 9,067 yuan per metric ton in July to 8,036 yuan per metric ton. And diesel fell by 12.25% from 7,925 yuan per metric ton in July to 6,954 yuan per metric ton.
Wow, that's a steep decline. What about petrochemical products? We know that they're closely related to the international crude industry.
The international price of naphtha has decreased even more than crude. For instance, the freight on board Singapore price dropped by 33.10% from $973.46 cents per metric ton to $651.24 per metric ton. Asian olefins declined over 20%. Ethylene, propylene, butadiene were down 20.8%, 26%, and 23.53% respectively.
Since olefins have been so deeply affected by this, is there any other industry that has been affected?
Yes, there have. Aromatics have felt the pressure also. For example, the prices of benzene, toluene, xylene, and styrene in East China dropped by 27.58%, 26.04%, 26.35%, and 23.53% respectively.
It seems like we're back in 2008. Is the entire market like this?
Not the entire market. We can look at the 4 major polymers and see the decrease has been more moderate. Polyethylene, styrene butadiene rubber, TDI, and polyester filament yarn prices have dropped 13.33%, 13.08%, 13.79%, and 13.74% over the 4-month span that we're talking about.
Is this drop very typical?
The petrochemical products I mentioned are typical. We can say the slump was partially caused by overcapacity, weak demand, and stiff competition, but really the complete collapse of international crude price has been the main cause.
Derek, as most market watchers are aware, China has been developing a new coal chemical industry. In your opinion, has the collapse of the international crude price influenced China's coal chemical industry?
The short answer is yes. China's worked hard to develop and expand the coal chemical industry over the last 2 years. Specifically, we're talking about products like coal to liquids, coal to gas, coal to olefin, coal to aromatics, that kind of thing. The capacity of coal to liquids projects under construction right now is more than 30 million metric tons. When the oil price is over $100 per barrel, coal chemical projects are profitable and everybody's happy. Declining oil prices put pressure on the profitability of the coal to liquid industry, and oil is running about 30% lower now than it was last summer.
Since it's running so low, how are people feeling about this?
Well, there are plenty of people who are understandably nervous. $70 per barrel is the generally accepted break-even point of coal to liquid projects. Below that level, profits become losses. The more oil prices decline, the worse the losses become. And it absolutely kills any incentive to invest in new coal to oil projects. I mean, what's the point of investing with an almost guaranteed loser?
That's very true, Derek. So we should remind Chinese investors to pay close attention to the crude price on the coal chemical industry as it runs serious risk. Can you describe some particular impacts this may have?
Yes, according to my Chinese colleagues, the price of coal-based olefins are 1,000 yuan per metric ton lower than the oil-based variety when the price of oil is at $100 per barrel. But of course, the profits of coal-based olefins shrink in line with the dropping crude price. Let's look at propylene for an example. It has 3 main production processes: naphtha cracking, methanol to olefin, and PDH. The naphtha cracking process costs less, so there's that advantage. When the international oil price is $70 per barrel, the cost of naphtha cracking propylene is 7,000 yuan per metric ton, and PDH propylene is 6,800 yuan per metric ton. Compare that to the methanol to olefin cost of more than 8,000 yuan per metric ton. With the current price of propylene in East China at 7,300 yuan per metric ton, it's easy to see that Chinese coal olefin projects, including those in Shandong, will almost certainly feel the strain. We can definitely expect production delays.
Looking outside of China, how can we expect this crude price drop to impact the U.S., and especially with the shale oil revolution currently happening in the United States?
As many people are aware, last week OPEC scrapped plans to reduce production, a move that almost guaranteed that oil prices are going to continue to drop. This is bad news for the emerging U.S.-based shale oil suppliers. As long as oil was over $100 per barrel like it has been the last 4 years, shale oil extraction techniques are profitable. But the further the price drops below that magic line, the harder it will be to convince the rest of the world that shale oil is indeed a reliable new energy source.
Would you say that OPEC is trying to put shale oil producers out of business?
I think that's a good guess. They wouldn't mind if it happened. That's what you do with competition in the business world. Before the recent oil slump, market expectations called for the U.S. oil supply to increase from the current level of 8 to 9 million barrels per day all the way up to 11 million barrels per day by 2015. That would push the United States past Saudi Arabia and make it the world's largest oil producer. But the current price of less than $70 per barrel puts more than half of the U.S. shale oil wells below the break-even point. There's been a decrease of nearly 40% in applications to explore for new oil, thanks directly to the crude slump. We can safely say the U.S. shale oil and gas boom has been essentially stagnant since 2007.
All this news that you're reporting to me, Derek, sounds pretty negative. Do you have any good news for us or our audience?
There's a flip side to cheap crude oil. With the global economy still trying to recover from several rough years, we can expect that this relatively inexpensive crude will be somewhat of a boost to the economy and stimulate consumption. Oil importers should see this as a significant buying opportunity. Let's take China as an example again. If oil were to fall all the way down to $10 per barrel, China would save 60 billion, that's with a B, US dollars in import costs. So the crude slump could help maintain a stable Chinese economy and also help the global economy recover.
All right, that's all very interesting, Derek. We thank you for being here today.
Thank you.
All right. With all that information, with international crude prices dropping, ECI will be there at every turn to let you know what's happening in the market today.